Hi everyone. I just wanted to follow up on that comment around the medium-term take rate and servicing rate for the Helic and Auto in your experience, or do you have any sense for how long a new product takes to reach mature unit economics? Andrea, you mentioned maybe not 12 months but 12 to 24 months. Will they be mature by then, or is there scope to improve beyond sort of that 1 to 2 year time frame?
Yeah. A great question. The beauty of our business is that there's not really any moment where we deem a product mature, because the margins ultimately are driven by the level of differentiation that have been created by our technology. And so, it was a lot of years before our core personal loans product reached its current level of take rates and its current contribution margins. We were doing that for probably 7 to 8 years before, we got to levels like the ones that we have today. And that's basically because year after year, the models kept getting better, the level of automation kept getting better. And that's really the thing that allows you to be able to get pricing power in that market when the next best offer is so far away that you can increase the take rates there and still have the best product. That's where it makes sense to start ramping that up. So I would say we are very much in a position today where these products have found a great fit in the market. We are ready to start optimizing their margin profiles. But it's not like they're going to be done optimizing, this year or even next year or probably even the year after that. They're going to just keep getting better as we create more space for differentiation and therefore more space for pricing power. And we view that as a fundamentally very good dynamic in our business where we can keep on improving the technology. That keeps on creating more differentiation, which then allows us to have more pricing power. But we do expect these pro products to get meaningfully better in their margin profiles in the near term.
Okay. Thanks. And just wanted to ask too about the Cashline product. Can you talk a little bit more about who the target user is for that? Is it something you see as a complement to personal loans, or maybe more of a substitute for someone who doesn't need or want 15 to 20,000? And then what about the economics there, like origination fees, and do you expect that those are balances and loans that will sit on your own balance sheet? Just any color you could provide there would be interesting. Thanks.
Yeah, Cashline is a product designed for someone who has generally a need for a smaller amount of credit but on a more regular basis. So, if you think of personal loans as a one-shot $10,000 loan, a Cashline is we're talking about hundreds of dollars, but something that you might access multiple times a month, multiple times a quarter. And so the design of the product needs to be very different. But it's actually still a really valuable loan, a really valuable customer, because it's accessed so frequently over a period of time. And so that's who it's designed for in terms of its funding. Yeah, in the medium term, as that product grows, it's going to have its own sort of dedicated funding partners that are the right home for it. But because the product is so short term, the loans are so small, it's not a major factor in the balance sheet today. And it's not something that we're particularly worried about.
Yeah, good afternoon. Thanks for taking my questions. Paul had a couple questions, but both related to how we ought to be thinking about the impact of the shifting origination mix. Specifically, more prime personal loans. Helic by definition is going to be more of a prime borrower. And first just focusing on capital. It looks like, a third of your, retained risk on the balance sheet is the beneficial interest. That's sort of the co-investing. Should that relationship or percentage drop over time as a bigger part of your business becomes prime focused? Because it seems like that the investor part of the marketplace is going to require risk retention to a greater extent the lower rate of the credit. Can you just walk us through if the balance sheet is going to change as the mix shift of your originations change?
Yeah, it's a good question. I think I maybe want to start by just correcting a misconception about the required level of risk sharing. I mean really when we thought about when we looked at our business over the last few years strategically, one of the most fundamental convictions we had was that we had confidence in our credit but we didn't have control over what happens in the outside market, and so there would be market environments where funding was less available and there would be market environments where funding was more available, and much of it would be outside our control even if our credit was performing well. So we felt it was strategically critical to us in our desire to build the sort of largest provider of consumer credit that we needed to have capital arrangements and capital partnerships that could endure through market cycles. And so putting in risk a small portion of risk sharing into some of these deals was fundamentally in exchange for having committed capital over multi-year windows. And so we don't view that necessarily as a requirement. It's certainly not a bad thing. We actually view it as something pretty innovative that allows us to solve one of the most important sort of fundamental challenges in a fast-scaling business like ours. Coming back to your question on newer products and prime mix and how that will affect it. I think you are right that the sort of primer products TT will tend to have a lower sort of level of capital required from a risk-sharing perspective. But I wouldn't necessarily leap to the conclusion that the ultimate mix will be any particular sort of mix of primeness, and that's because we have so much growth in multiple product categories right now where we're putting a lot of focus on growing that core personal loan segment, which is an extremely strong segment for us, a very profitable segment. We have a lot of growth in the auto product, auto, which is a product that every American across the entire economic spectrum needs, and you are right that of course the HelloLock product it tends to be a more prime product, but depending on the sort of exact rate at which each of these products grows, you could end up either, with any particular mix of primeness.
Got it. Understood. That's helpful. And maybe just as a follow-up, sort of applying maybe the same rubric to kind of the medium term, the 3-year guidance. The 35% revenue curve is obviously significant and margins going from 21 to 25 is a material as well, but the margin increase is possibly maybe not as much of a pickup as we would expect with revenue kind of more than doubling, increasing 2.5 times over that time frame. Is that related at all to kind of product mix, or should we just interpret that as 3 years from now you still anticipate being in growth mode and probably still in an above trend period of investment spending?
Yeah, more the latter. So we are expecting this business to grow at a significant amount for a long time. Obviously, we gave the 3-year guidance of 35% CAGR, but that maybe the interesting thing about that from the perspective of your question was that 35% was approximately the same amount of growth that we guided to in the first year as the later years. And so maybe you might infer from that it's not heavily front-loaded like it might be for a business that you expect to grow a lot and then basically just taper off. We think the market opportunity here is so large across so many new categories of credit that we hope to be doing this for a very long time, and so it is our working expectation that there will be great opportunities to reinvest profits into continuing to grow the business over time. And I couldn't tell you today, given we've got 3 years of guidance, I couldn't tell you what is going to happen in year 4, year 5, year 6. But if I had to guess, I would guess that there's going to be great opportunities to reinvest for some time. And so that's what's in our plan today. Great. Well, thank you everyone for your questions and for your time today. I just wanted to leave you with a few things I hope you can take away from our conversation. First, Q1 was strong and puts us comfortably on track to deliver our full-year outlook on both revenue and profit. Second, core personal loans is our superpower. It has great margins and we're going to do a lot more of it. Third, home and auto have found their places in the market and it's time to make them profitable. And finally, the opportunity ahead for us for AI to remake consumer credit is enormous, and we intend to go after it while making every dollar of capital count. Thank you to our team, our capital partners, and our shareholders. We look forward to seeing you next quarter.